catches me every time. Get dressed, Andy. Get dressed. Get dressed. Good. Great to see everyone. Welcome. Dry morning, arranged perfectly for today. Glad you could all make it. Nice to see you. And to everyone who's coming in on stream, welcome. Nice to see everyone today. So I've got a little bit of housekeeping to run through before the guys tell you all the good news about what's going on in the financial markets. Firstly, mainly to people coming in on stream, we do have some sunlight occasionally. I know it's November and it's bizarre, but we do have a bit of sunlight coming through the windows, which if it does come in, it tends to blank that screen momentarily. So if that happens, and you're watching online, don't fret. It'll sort itself out in a few seconds as the clouds move back in. Also, for those of you online, any questions as you are watching the stream, just put your questions through on Slido. Jen will pick them up and we'll try and cover them all off at the end of the presentation. You've all got your lovely little pens. You may be aware we are a carbon neutral firm, which means we are pretty careful about what we do, but we also submit an annual return to an organization based in Switzerland who does accreditation. So we do a check on that every year. We have to pay them some money because we're not entirely carbon neutral, which goes into various sustainable projects. But the pens are just a little thing. They're made of paper. I forgot this last time. I had to be reminded. I'm old and my memory doesn't operate anymore. They are paper and inside it's stainless steel. That's it. So it all ultimately can be recyclable. And if you chew them, they do actually disintegrate. So don't chew them. Another thing you may have noticed or you may have been aware over the last few months, we had a little thing in our email in terms of a supporting cancer campaign. Angela's husband Duncan has been battling away with cancer for a few years, and the guys decided to do a big charity raise for cancer back in September. Months fly by. September, where they organised a big walk in Oxford. Plan was to raise 15,000. They've raised over 40,000. They had over 100 people there on the day. It was an exceptional day. So if you were involved in that in any way, shape, or form, it's been a tremendous success. So well done, Angela. Budget. I won't talk much about the budget because we all pretty much knew what it was going to be because they tried one, didn't work, so we knew what the we knew what the alternative option was going to be. But within that, in terms of inheritance tax, they again, as expected, they've frozen the thresholds till I think 2028. They've now been frozen since 2009. So more and more people unexpectedly are going to come into inheritance tax territory. So it's just flagging it up, be aware of it. Advisors, myself, Clara, Bill, where it's appropriate, where it's necessary, will pick that up in conversations with you guys if it's impacting you and look at what can be done to try and retain money within your family as opposed to giving it off to HMRC and the Chancellor to do whatever they're going to do with it. That's it. I think that's my bit. So I am done. I shall hand over to Andy.
Thank you, Brendan. When I started to put my part of this presentation together about 3 or 4 weeks ago, Angela said to me, whatever you do, make it positive. Yeah, thanks. We're going to try and give you a little bit of background and context here that perhaps will have you leaving here a little bit less negative than you were when you walked in. It's been, to say the least, an interesting year. But as always, we will start with the numbers. At the end of the day, ultimately, everything we try and do on the investment side is to try and make you more financially secure, so we don't hide from what these are. And we'll look at, as usual, the 6-month period to the 30th of September, since we were last here, so second and third quarter. And as you're well aware, it's been a very difficult period for markets. Nick will put more meat on the bones of this in a minute. But universally, if you look at our Ruby portfolios, our core portfolios, they are down across the board. What's particularly interesting, and again, we'll cover this in more detail, is that whether you've invested at the normally what would be considered the higher risk end with more equities, shares, or whether you've been at the more normally conservative or typically lower risk end with more in bonds, corporate bonds, government debt, that kind of thing, it hasn't made an awful lot of difference. It's been a pretty difficult period for all asset classes. So you see a fairly similar picture across the board. If we then go to a slightly longer time frame, what I should put, that's the core portfolios. Gaia, which is our sustainable and positive impact portfolios, similarly down. They've had a little bit of a tougher time at the upper risk end, for reasons, again, that we'll touch on in more detail, as sustainable companies have had a bit more of a headwind after a particularly good period. But as we are aware, a difficult period across the board. If we look at, this is kind of the pandemic time period, really. I've been putting this up for a while, just to give ourselves a feeling. The way we kind of often look at the world is what's been going on since the 1st of January 2020, when we were all blissfully ignorant of what was coming. There was this thing going on in Asia, but there'd been bird flu, there'd been other things like that, and that hadn't ever really broken out, and we had no idea what was coming down the track. If you look at the longer period, actually, in spite of what's gone on this year, most of the portfolios are in positive territory. So this is a question of having gone up and come down a bit over this pandemic period, which, considering what's happened in that period, is relatively pleasing. And if you put the Gaia portfolios on, they have done particularly well. So even though they've had a tougher 6 months, for various reasons which we'll cover, that's after having a particularly strong couple of years. So what you see is that if you look at the longer term, things generally are still okay. And if you look at the 5-year numbers, we don't have 5-year numbers yet for the Gaia portfolios. They aren't that old yet. But for our core portfolios, which have been going now for some 11 years or so, we look at the 5-year numbers, you can see that they are all in positive territory. They are, as you might expect, more typically, when things go up, the higher risk portfolios make a bit more than the lower risk. But equally pleasing is these grey bars are the investment association averages. So these are effectively funds that you could have bought of similar risk levels, and we are ahead of the averages. So what we are doing is we are managing to do what we intend to do, which is make you a bit more money than the average, whilst trying to manage those downside risks at the same time. So the long-term numbers still look fine. And actually, if you look at that, up the upper end, you are talking about 10% per annum return. So this is still very good in spite of the shorter-term issues. Okay. Now I'm going to pass on to Nick, who's going to put the meat on the bones as promised.
Okay, I'll take you over what's happened over the last 6 months. Much of what I'm going to tell you, you know. It's been very well covered in the media. So we'll look at performance, first of all, over the last 6 months. So over this period, over the last 6 months, UK equities are down just over 8%. The figure in green underneath is what they've done over a calendar year to the end of September. UK gilts, or government bonds, issued by the UK government over the last 6 months have fallen by just over 19%. And index-linked bonds issued by the government, something you might assume might help you with inflation, has fallen slightly over 25% over the last 6 months. Corporate bonds, so bonds issued by companies, fallen by 18%. European equities, fallen by 10%. US equities, a bright spot, fallen by 6%. Chinese equities, fallen by 5%. Emerging markets, fallen by 7%. And Japanese equities, fallen just by over 5%. So a particularly unpleasant period in markets. So what's driven this? Well, during the pandemic, we know that governments and central banks came together to try and shield us from the worst economic effects of lockdown. And we know there were schemes such as furlough, and interest rates were lowered as well. across developed markets. And what this meant is that actually personal savings as a percentage of disposable income went up very sharply, as we were given furlough at a time when actually it was quite difficult to spend money. This is looking at America. We're looking at US personal savings here, where we can see the long-term average is sort of around 5%. And we get to the pandemic, and the savings rate goes up tremendously. And of course, after it, as economies start to open up and you can start spending that money, the saving rate goes down sharply as people start spending this money. So what this has meant is that there's been an explosion in demand. We've heard a lot about supply chain inflation, inflation caused by issues around the pandemic, factories being closed due to COVID and the likes of that. But if we look at the long term, this chart here shows you US personal expenditure in billions of dollars, so actually in cash terms. It goes back to 1997, and we can see this long-term trend line of expenditure in the US, personal expenditure. And generally speaking, there's this clear long-term trend. However, we get to the point of the pandemic and reopening, and it goes through the roof. So what we've had here, it's not just been an issue about supply chain inflation, it's a huge explosion in demand that we've seen at the end of this period. And we know what happens if demand exceeds supply, we know what happens to prices. They go up. And it's not just been in goods. The same story can be seen in services as well. There's a clear trend line here, normally in expenditure, but actually since reopening, the amount we're spending on services has gone up as everyone's been desperate to get out there and spend their money that they've saved again. And obviously this time, within service companies, it's very much been a labour shortage that has impacted inflation in this case. So this has led to inflation hitting levels that we haven't seen since the early 1980s and the 1970s, which you all well know. This is US inflation I'm showing here. US inflation has gone to over 8%. As we well know in the UK, it's even worse. We've had inflation go over 11% in the UK. But in the US, we have to go back to about 1981 since we saw inflation at these levels. It's a really massive spike. What have central banks done to respond to this? Well, they've done about the only thing that they can do, and that's to raise rates. And they're trying to take demand out of the economy. They're trying to literally take money out of our pockets to stop us spending it and try and lower the demand in the economy to get inflation down. So rates have gone up very sharply in the US from 0.25 for a long period of time, and now they've raced up to 4% over this period. But it's not just, as we well know here, it's not just in the US we've seen that. In the UK, that's the orange line here, rates have gone up very sharply as well to 3% today. And even in Europe, somewhere where they've suffered from deflation over the last decade, we've seen rates go up. But look at this yellow line here. This is Japan. Look how that hasn't moved at all. Japan hasn't seen inflation like we have over here. Japan didn't have the furlough schemes to the extent that we had here. And they haven't had that massive demand rush that we've seen over here. And consequently, they've not had to put up rates. In fact, they're still hoping that inflation might even go higher there. And a similar story can be seen in China as well. So I think you can see that where we've had the massive amounts of inflation has very much been those economies where you had the big furlough schemes and the central banks sort of cutting rates as well. Monetary policy is a blunt tool. It acts with somewhere between a lag of a 6-month to an 18-month lag. So from a central banker's perspective, it's very much more of an art than a science. They don't know exactly when it's going to have an effect. So their difficulty is, with inflation going up, how much do you put up interest rates and what point do you stop before it starts having an effect? If you carry on and just carry on putting rates up until inflation starts coming down, you will cause the most horrendous recession. Central bankers know this, so their art is trying to judge at what point they pause putting up rates. So the conundrum that their central bankers have had is how sticky inflation has been. Once again, looking at US inflation, the blue line here is what we call headline inflation. And what we mean by that is inflation including food and energy. It peaked in June, and actually it's been coming down since, as food and energy prices in the US at any rate have declined. However, core inflation, which we mean by inflation excluding food and energy, has carried on going up. And this is the conundrum for central banks as they put interest rates up. We've still got prices going up. How do they decide at what point they stop putting rates up? This is made harder for them by the strength of the US labour market. So this chart here shows US job openings by industry. And as I said earlier, normally we can see some sort of a trend line in job openings in the US going back to 2000. There are peaks and troughs as we go through recessions and come out of recessions, but broadly speaking you can see there's a trend line. But once again, as we get to the end of the pandemic and reopening, we can see this huge surge in job openings. These number of job openings accounts for 2 job openings for every unemployed person in the US. And so once again, this makes it very difficult for the US Federal Reserve to decide when to start cutting back on rates. Consequently, what we've seen is a massive increase in the strength of the US dollar as we've just seen we've seen interest rates go up in the US much faster and higher than anywhere else. So what we've seen is the US dollar appreciate against virtually all the other major currencies. This is the blue line here is the US dollar versus sterling. So it's appreciated around about 20% versus sterling. It's appreciated by a similar amount versus the Japanese yen. And even the euro, it's increased by about 15%, and the Chinese renminbi as well. When the dollar soars, that sucks liquidity out of financial markets, and it's not a great situation for financial markets. And that's very much what we've experienced over the last 6 months and has led to some of the pain that we've seen in financial markets. Normally, in any period of time within equity markets, whilst there are some areas of the market that are going down, normally there are some areas that are going up, more defensive areas. However, over this last 6 months, it just hasn't been like that. So consumer staples, i.e. supermarkets, well, we all still go to the supermarket. We haven't stopped going to the supermarket. A traditional defensive sector over this past 6 months have fallen, the share prices have fallen. Utilities, telecom companies, water companies, share prices have fallen. Commodity companies, share prices have fallen. Tech companies, okay, perhaps we knew tech companies were expensive. Perhaps that's not so surprising. Share prices have fallen. Real estate companies, offices, still half full. Share prices have fallen. Financials, however, banks actually benefit from raising interest rates. All those reserves they hold at the central bank are suddenly earning interest that they haven't earned interest for the last decade. However, over this last 6 months, share prices have fallen. Energy companies, well, we know what's happened to the oil price. We know about the supernormal profits they're making. Over the last 6 months, share prices fell. Pharmaceutical companies' share prices fell. Industrials fell. Telecom companies fell. Corporate bonds fell. There's been, in equity markets and even in fixed income markets, there have been very few places to hide, with perhaps the only place, the US dollar. So after this particularly torturous period, what does the outlook look like? Well, the Fed is now, as I said earlier, they've got this conundrum. They've got to try and decide at what point they pause putting up interest rates. And at that point of pause, that will probably be taken quite well by financial markets. However, inflation itself is a lagging indicator, so they won't be looking at inflation numbers to try and judge that by itself. They will be trying to look at other figures to judge when they make that pause. This chart here shows something called the US Manufacturing Purchasing Managers Indices. It's essentially a survey they send out to companies asking them what their business environment is like. Are they hiring? What's their order book like? You know, what are they doing? Are they investing? Any number above 50 represents us being an expansion. Any number beneath the orange line represents contraction. And what we've seen after the reopening, we saw this number go sharply into expansionary period in territory. But since then, it's come all the way back down, and now it's sort of hovering around the 50 level. So we're neither sort of in expansion or contraction territory at the moment. If we were falling into recession, we would expect this to fall into the low 40s. So we're not there either. However, it has slowed down. This will be the sort of data that the US Federal Reserve will be looking at. Job openings. I said obviously earlier how strong job openings have been in the US. However, as you will have noticed towards the end, it is showing signs of beginning to tail off. Now, the actual latest data has actually ticked up slightly. However, it doesn't disrupt that slight downward trend that we've seen of late. But the US Fed is going to want to see this coming down before they've got comfort that they can start, pause with their rate hiking cycle. US building permits. In the US, in the UK, the average fixed interest mortgage left to run is something got about 3 years to run. In the US, when they write mortgages, fixed rate mortgages are written on 30-year fixed rate mortgages. So when they put up rates, it has much less impact on homeowners. However, if you're buying a home for the first time, you're still going to be faced with the same issue that we see in the UK. Sharply higher mortgage rates, more than double what they were a year ago. And what we're now seeing is a slowdown in the sort of new house market in the US. And obviously, you imagine the impact that house building has in the US. When you build a house, you have all the plumbers, you have all the furniture you buy, you have all the ancillary services. So as that starts to slow down, the impact on the economy is really quite marked. And what we've seen is a sharp reduction in US building permits in the US as those very steep mortgage increases start to impact new buyers. So essentially, what this leads us to believe is that we think that we're that much closer to there being at least, if not a pause in the interest rate rises in the US, at least a slowdown. US interest rates have gone up by 0.75% 4 times in a row. I think that as this data starts to come through, we might expect to see that rate rise starts to come down, to go up maybe by 0.5 or 0.25 before we get a total pause. They will, of course, be looking at inflation. This is an update of that chart I showed you earlier, and it just shows you in the last inflation print how that core inflation, excluding food and energy, has ticked down slightly. And actually, on that day that data came out, the US stock market rose by 5% in one day, with technology stocks rising by over 6% in one day. And it shows you what investors are looking for. They're very much looking as well for that point that the US Federal Reserve might start pausing on interest rates. So looking forward, where do we see the opportunities? Well, fixed income yields, i.e. essentially the interest you now earn on owning government bonds or corporate bonds issued by companies, we can actually say today is much more compelling than what it has been for a long time. Over the last few years, when we've been coming to these meetings, we've been looking at the interest rate you earn on these bonds falling down and down and down. Last time I saw you, it would have been beneath 2%. Where suddenly today, you're getting an interest rate above 5% on holding fixed income bonds. Far more compelling than we've seen for a long time. Fixed income has very much been in the eye of this storm. And equity valuations, i.e., how much are we willing to pay for every £1 of earnings from a company? We call that a price to earnings multiple. And what this chart here shows you the price to earnings multiple of the US market in the blue line and the UK market in the green line. And what we can see is that in the last few years, this multiple had got very expensive in the US, over 25 times. But actually, it's come down very sharply, and it's come down beneath its near-term average in the US. And if we look at the green line, the UK equity line, which was a cheap market anyway, it's come down tremendously, far beneath its near-term average, to a level you might expect to see in a recession. However, what we've seen here, this has been much more of a, if we talk about this, the price to earnings ratio, what we've seen here is the price that has come down. What's going to be critical from this point forward is what happens to company earnings. If company earnings can hold up, then actually this is probably an amazing buying opportunity. But looking forward, if company earnings weaken, then there could still be another leg down in equity markets. However, if you have a long-term view, today probably is a decent entry point into equity markets, acknowledging there could still be a further fall, whilst fixed income markets really do look quite compelling to what we've seen for a long time.
Thank you, Nick. So, as instructed by Angela, I will try. I had a good look, scratched my head, thought a lot, and I found the most important piece of good news, which is that. That's my good news. It's not been the best thing to be an Arsenal fan in recent years. It is a good time to be an Arsenal fan now. My boys are very excited as well. My 12-year-old is utterly convinced we're going to win the league. I don't think we are, but there we go. We'll enjoy it while it lasts. So I thought I'd share that with you. Now let's move on to the more mundane things. UK politics. Let's try and put some context on some of this stuff. How bad is this stuff? Are we in laugh or cry territory? 50 days. I think we all know what 50 days is. It is the time that Liz Truss was Prime Minister. That is the shortest in the UK on record. Previous record holder was George Canning, was 119 days, so markedly shorter than anything before. And unfortunately, Mr. Canning, he ceased to be Prime Minister because he had a heart attack and died, unfortunately. But again, perspective. There have been worse. This chap called Pedro Lascaran, he was President of Mexico for 45 minutes. So 50 days, it really depends how you view it. It's quite a long time. Just to explain, it was in the middle of a coup in 1913. The army decided to take control, and they needed somebody to basically authorize them into power, sign the necessary documents. I suspect it was a bullet or a signature was the choice that the man faced. So he was appointed president so he could effectively sign his position away and allow the army to take charge. So, there's always someone worse off than you. Did anyone recognise this number within the context of UK politics? This was bounced around quite a bit, 0.2%. It was the proportion of the population that elected Liz Truss, which is fairly unusual. It's happened before. Parties have elected leaders whilst in power before. And then, of course, that number was the proportion of the population that elected Rishi Sunak. So we are getting smaller and smaller and smaller. So there's no doubt in UK politics this has been an extraordinary time. However, we invest globally. We don't actually have massive exposure to the UK. So for you and all of us that live in the UK, you can look at the headlines and cry and think, oh my God, what a mess. And there's no getting away from the fact that the UK faces some major challenges, but it hasn't actually impacted your investments particularly. And that's really important to get the headlines separate from the reality in terms of that aspect. Headlines from BBC News. Mortgage rates hit fresh 14-year high. Let's talk about interest rates then. Where are they in context? And then another one. The Federal hikes US interest rates to fresh 14-year high. The number comes up a lot. It doesn't matter where you look. It's 14 years. So why is it 14 years? Do we have high interest rates? Okay, well, let's have a look at that. Well, that is the current UK base rate, 3%. As we've done these presentations over the last few weeks, they've had to be updated quite regularly because quite a few of these numbers have been changing on a quite rapid basis. The average interest rate, the UK base rate, for the period 1975, which is as far back as the Office of National Statistics publishes data, to 2022, is 6.24. So we're less than half the average for that period. But if you chop out the last 14 years, which seems to be the number in all the headlines, you get 8.62. Now, I think there's a few people in the room like me who are old enough to remember significantly different numbers to even those. So I went to the ONS and I got the rate on the 1st of January every 5 years just to put some context on this. And we see 11.25, 1980, 17%. And I think some of you remember these numbers. 9.5, thick end of, that's a rather odd one. I'm not sure why it's 13.88. Somebody at the Bank of England or in government was playing with some very precise numbers at that point. 6.13. And it kind of comes down through this period as we get into the new century, the new millennia, when the Bank of England started to target 2% inflation, and we got away from these really high inflation numbers. We had got away from high inflation that led to these high interest rate numbers. But it's really this period that's been the weird bit. After the global financial crisis, we had really, really unusually low rates to allow the global economy to recover. And you can see that, 0.5, 0.5, then 0.25. So this move up to 3 is very painful for people who have not experienced normal rates for a long time. There are some people with mortgages have never experienced normal rates, and there is no doubt there will be some people that have probably borrowed maybe a bit more than they should because it was so cheap that are now going to really, really feel the pain. But in total context, are UK interest rates high based on history? Not really. Just higher than we've seen them for quite a long time. So it is worth putting that in context. Inflation. That's US interest rates. Again, the same thing. They've gone up quite sharply, but again, that's the longer term graph going back to the 1950s. In the grand scheme of things, not particularly high. So interest rates have gone up quite a bit relatively, but in absolute, not really that high. But what about inflation? No getting away from this. This is high. Nick's covered it. I just wanted to put, just the context on it in a slightly different way. That is Office of National Statistics. That's UK inflation. That's the Wall Street Journal. I like that. Inflation hurtles to highest since 1981. I like that word, very descriptive, but it's right. It's gone very fast and very hard. Yeah, there's no getting away from the fact that inflation is the issue. So whatever context you put on anything else, that is definitely challenging. But what about markets, which is what it all really comes back to? I've pulled out some of the difficult periods in recent history, going back to the oil crisis of the 70s, to look at how markets have done in these various occasions. So the oil crisis, Black Monday, the tech bubble, and so on and so forth. Okay, and if we rank them, the global financial crisis, and I've used the US stock market here to show what markets did. It is the biggest market in the world. Obviously, there were some differences in different geographies, but let's look at the S&P 500 and what it did. In the global financial crisis, that fell by 56%. That's the worst of these particular periods. The tech bubble, you remember we were all going to buy everything online immediately tomorrow? Yeah, that was 49%. The oil crisis was 48. It's about that 50% mark. Good old-fashioned proper stock market crash, about 50%. There is history for this. Does seem to be fairly repetitive. COVID. Flash crash, it was sometimes called. As you remember, it fell very, very fast. Before you could blink, it was tearing back out again. Very, very rapid. It was 34%. Now, peak to trough, 24%. And Black Monday is the least bad, 21%, but that was one day, in fairness. So it's not surprising. It's probably the least, but still a brutal, brutal day. That's if you were a US dollar investor investing in the US stock market. But there's been another big factor this year. If you were a sterling investor, like all of us, investing in the US stock market, you saw similar figures as an investor in terms of your losses. In other words, sterling didn't move very much versus the dollar. Didn't make it worse or better. You invested in American stocks, you had about a similar outcome. But the more recent ones are markedly different. So if we look at the global financial crisis, you only lost, and I do use that slightly generously, only lost 36%. That's because the dollar strengthened massively against sterling in that period. So whilst your American share was falling, because it was in dollars, it was having that uplift as well in the currency. It's like when you go on holiday. If sterling's low, it costs you lots to buy dollars, but equally if you're invested in an American share and the dollar strengthens, you get more pounds when you translate it back into sterling. So because the dollar went up, it helped offset 20% of that fall. COVID, not quite so much, but it was a very, very short period, if you remember. The market came down very quickly and up very quickly, but you still had a bit of a buffer from sterling. But this time around, it's been really big again. Sterling, as we all know, if you've tried to go abroad or buy holiday money, has weakened massively. As Nick said, the dollar's got strong against most things, but sterling has been particularly hit. And it's meant that if you were invested in the US stock market, as a sterling investor, you've only, and I know it's a negative number and none of us enjoy negatives, but sterling has helped us and has bailed us out to a degree. So what would have been a 24% loss if you're an American is only a 9% loss as a sterling investor. And that has been very helpful. And in the grand scheme of things, whilst none of us like negative numbers, has meant this has been a fairly limitedly painful experience, but still not obviously enjoyable. Good news, there is a bit more here, and it's not football. I resisted putting a slide about England in because, I just thought it was too obvious. Here is the discretionary performance on the portfolio since the 1st of October, which is therefore not in the period covered previously. Things are getting a bit better, okay? So you can see that we have, Nick mentioned, when that inflation print came in the US, and it looked like inflation might be now rolling over, markets reacted very positively. Things are looking a bit better. It's too early to say we're through it all, because you never know with markets when you're through it all until after the event. But things are showing signs of recovery, and that is quite a sharp recovery. As you can see, the portfolios at their upper end are up. I mean, Gaia's up nearly 5%, and Ruby is up at the upper end 6.5% to 7% in about 6 weeks. That's a big move, and it is giving people some optimism that we might be getting near the end of this very difficult period. So if I take you back now to this slide, which was to the end of September, consistent with all the other performance slides that I put up, if you watch now the figures down here, and I now build in that extra little bit since the end of the quarter, we're now down 16% and only 6% as a UK investor. So it's not much to hang on to, I grant you. We never like negatives. But in the grand scheme of things, the impact on you and your investments has been quite muted. We have used currency hedges to try and lock some of that gain in, if you like, or reduced loss. But I just wanted to give you something that might allow you to leave here thinking the headlines are cataclysmically bad, but the impact on you as investors is nowhere near as bad as you might think. And finally, for those of you who've been coming here a few times, I have been asked to complete the story. The other bit of good news, I did get my car. It did, finally, after 53 weeks, it did arrive. For those of you that are new, I apologize if you've no idea what we're talking about, but this has been our supply chain example and how appalling supply chains have been and how it's impossible to get hold of a new car. Unfortunately, it's got to go back. After all that, because the electrics are not working properly, I'm really hoping it's only got to go back to the dealer and not all the way to South Korea, because bear in mind it took a year and a bit to get here in the first place. I'd rather not have another 2-year round trip to get it repaired, but we'll see. But for now, at least I can drive. So on that, I will pass over to Phoebe, who will tell you what's been happening in the world of sustainability.
Thank you. Thanks very much. Okay. I think I pressed the wrong button. So Nick and Andy have given you a bit of an overview of what's been going on in the macroeconomic environment and the challenges that different markets and indices, so groups of stocks or groups of assets have struggled, the struggle that we've had, have been reflected in the sustainable world and the sustainable investment landscape in the very same way. So hopefully the last set of sort of negative stats to throw at you, I thought it would be helpful to see a range of different asset classes on the same chart. So this is over the last 6 months up until the end of October. The blue line there is the FTSE 100. So that's the glimmer of positive news, really, and it's still negative over that time period, down 6.4%. But really where things get a lot more astonishing is in this bucket of different asset classes. And we've got here a mixture of equities and of bonds. So the first one here is the Bloomberg Global Ag. That is an index of global corporate bonds. And this index has fallen by 15% over that 6-month period. That's been beaten to the downside by the FTSE 250, whilst the FTSE 100's been fairly resilient, because if you think about the makeup of the FTSE 100, mining companies, oil companies, tobacco companies, alcohol companies, either defensive or commodity-led sectors, those have been a lot more resilient than the wider market. The other factor is the fact that these companies are predominantly producing their revenues from overseas. So when those revenues are converted back into sterling, into pounds, they're worth more because the pound has fallen versus all of those other currencies. So the FTSE 100 has been pretty resilient. FTSE 250, different story. Those smaller cap companies down in the region of 17-18%. The MSCI World, that's the global stock market, down 18%. The Dow Jones down down 19%. The FTSE Gilts, so that's UK Gilts, down almost 20%, and the S&P down 20%. So a really bleak picture, regardless of where you've looked for investors. In the sustainable landscape and world, we're picking from companies in those same spaces. It's not as if we've got an entirely new universe. We obviously select the companies that uphold the sustainable values and the sustainable opportunities, but fundamentally they're coming from within the same indexes. So it's been very, very tough over the last 6 months. However, we have managed to avoid a few blow-ups, for want of a better phrase. This chart here, don't worry about the axes. Well, I'll tell you what they are. So it's December here, December last year to October this year. And you have here, this line here is the longest dated gilt. So the longest dated gilt is when the government borrows many, many years out into the future. If you buy this bond today, you'll have to hold it until 2073 to get your money back. So very long duration gilt. The return of this gilt, but you're only lending to the UK government, you'd think it'd be fairly safe. This gilt has fallen by more than Bitcoin, the other line on this chart, over that time period. That gilt fell in excess of 80% up until the end of October. This really demonstrates to me quite how extraordinary the last few months have been for us as investors. Avoiding UK gilts across the board, certainly avoiding long-dated gilts, has provided us with better performance than if we'd been holding those types of assets. We have had concerns on UK gilts for quite some time, where we want to hold government debt. We hold US government debt. The outlook for the US government is a lot more attractive, and there's a lot less uncertainty in the long end, so that long duration area for the US. We've also had the benefit of the fall in the value of sterling, of GBP. This chart here shows GBP versus US dollar exchange rate. Nick showed this chart versus a number of currencies going in the other direction. So this shows that at the end of last year, it was 1.35, the exchange rate between sterling and the US dollar. We went to overnight at one point this year, 1.03. Now, this fall in the value of sterling has benefited the sustainable portfolios, because where we're investing in equities in companies, we're doing so on what's called an unhedged basis. So when the performance is converted back into sterling, you benefit by the quantum of the fall. If we had hedged our currency exposure, we remove that risk, remove that volatility, but also you remove, in this case, the benefit of hedging the equities. We do hedge bonds. The reason for that is if we're not lending a company debt or a government debt, you're getting what's called a coupon, the interest payment. That's a fixed payment. If you have the influence of currency on top of that, the volatility, in this case is very, very significant, of currency on top of that, you're potentially detracting the entire value of that coupon. So for fixed income, we hedge it, we remove the currency risk. For equities, predominantly, we let the currency risk play out. And this year, it's been massively advantageous. In any given year, usually equities or bonds or the US dollar, as the three major asset classes, will do well. In this year, actually, it feels like markets have behaved quite irrationally. In reality, they haven't at all. And the US dollar has been, as is normally the case, the one asset class at least that's done well. What have we gone from here? Well, we had a lot of conversations as to whether to hedge, i.e. lock in the gains at that point. The way we could have done that in the sustainable portfolios would have been to hedge the US equity fund, a fund run by AllianceBernstein. You may see that in your portfolios. The reason against doing that, it's not clear-cut in any situation, is that if you look at that fund, it's investing in, let's say, 50 companies. The 80% of those companies are generating revenues from outside of the US. Until pretty recently, there hasn't really been much of an appetite for US companies to think about sustainability and think about the green transition. There has, however, been in Europe and in China, and I've spoken to you about that before. So the US-based companies get a lot of their revenues from outside of the US. When those are converted back into the US by the company and it's held in the fund, if you then hedge at that point, you're effectively short the US dollar. Now, given it's a safe haven currency, a safe haven asset, and we've clearly seen that this year, it's a very bold statement to make. So hedging at that point is kind of a double impact than you otherwise would have. So lots of conversations happening around that, but not quite as clear-cut as you would assume it would be. One of the things we've been talking about a lot today is inflation. So I wanted to sort of dig into that a little bit in terms of looking at the first investment theme for today. So we're all aware of the cost of living crisis. We're also probably aware of the cost of doing business crisis. A major part of that is the cost for all businesses in the cost of energy going up. A major factor as a result of the outbreak of war in Ukraine. So I looked at some data from Refinitiv to look at the factors affecting the change in European inflation. And interestingly, in Europe, almost 50% of the change in inflation is made up of energy costs. Now, that's almost double what it is in the US. Potentially unsurprisingly, the US is a net exporter of energy. Clearly in Europe, they were reliant, in some countries' cases, heavily reliant on Russian oil and gas. So taking that part out of the equation means that the cost of the proportion of general inflation, a lot of it is made up of energy. So how would you analyse which companies are going to be most vulnerable to increases in inflation? Well, one way you can look at it is by looking at classic sustainable analysis and looking at carbon intensity of a company, a carbon footprint. So carbon footprinting is something that you would do part and parcel of analysing how sustainable a business is. You look at the company's, the energy that it buys in. You can look at the energy connected to the goods and services of that business, the investments of that businesses, and understand the overall carbon footprint. It's what Phoenix are doing when they are becoming carbon neutral. They're calculating their carbon footprint, reducing it to the extent that they can, and that leftover bit, they're then offsetting effectively through those projects that Brendan mentioned. We do this across every company and every portfolio to really understand what the carbon intensity is from a sustainable perspective. But the other benefit is that you could really understand the companies that are facing higher energy costs because their carbon intensity, which is the carbon footprint per unit of sales, is higher. Intensity is important because you can compare a small company to a big company because you're looking at the carbon intensity, the carbon footprint per $1 million of sales. So we can look at this for scope 1 and 2. That's the internal carbon. Scope 3, that's what's happening in the supply chain. That's what's happening when the goods and services are used by the consumers. You might think it's strange that we would care about the energy that's used through the consumption of that product. But if you're producing a product that requires a lot of energy in its use, then your consumers might be hit by their energy bills. So it's actually important to take that into consideration as well. So this is sort of classic sustainable analysis that we would be doing part and parcel that you can use in a different way and really understand what the financial implications of businesses are through higher energy bills. This chart here is important to take into consideration. It doesn't just look at companies side by side. It looks at companies in the same industry. So it looks at the carbon intensity of, let's say, a dishwasher tablet manufacturer versus the average of all dishwasher manufacturers across the world. That Scope 1 and 2 is how that dishwasher tablet's made. Scope 3 is how it's used. That's pretty estimated because you're estimating whether someone uses it in a hand wash or in a dishwasher wash. And then the total is there. So using these side by side is crucial because you can see that relative to the sector, is this company massively energy inefficient versus what everyone else is doing? And are you investing in the right sectors, those sectors that have high levels of carbon intensity? So what are the sectors of high intensity? Chemicals businesses, a lot of energy used in the production of chemicals, and packaging producers. So there's a few ways you can approach this as an investor, and there's benefits from a sustainable perspective and a sort of standard financial perspective as a result of this. Well, we would look at the sectors that are most exposed to high energy costs. Now, those are companies with fixed asset capital intensity. What on earth does that mean? Well, that's companies with plants, with property, and with raw materials. So an easy way, exclude all those companies, and you're left with the rest of the companies that have low carbon intensity, lower energy bills, and then less risk from a financial perspective if energy costs remain high. But the other way of looking at it, and the way that we look at it in the Gaia portfolios, is investing in the companies that help these businesses get their energy efficiency levels up and their energy bills down. So companies that are deliberately providing solutions to high levels of energy efficiency, electrical efficiency, or automation. And it's very interesting to see over the last 6 months, many more companies than before have spent money and capital expenditure on ways to make their businesses more efficient, more sustainable in the process because the carbon footprint comes down, but actually spending money on bringing their energy bills down. So it's an interesting byproduct of the outbreak of war in Ukraine, of higher energy costs, and it's forcing this green transition to happen. It's really what the green transition feels like. It feels like high energy bills, but it feels like finding solutions and investing in those companies has been an interesting byproduct, as I said. The stat that really blows my mind is this one. So 75% of energy produced is actually lost in the generation, the transmission, and the distribution and the end use. So there is a lot of work that needs to be done by the energy companies, upstream and downstream, and those businesses using the energy to actually capture more of it all the way along. And so again, investing in companies that are enabling those businesses to be much more efficient, for want of a better word, in the supply of that energy all the way along is very, very interesting opportunity. Investment theme 2, since I last saw you, there's been a huge announcement from the US, which is the passing of the Inflation Reduction Act. So this began life as the Build Back Better Act. I probably spoke to you about this before, end of last year, beginning of this year, and represented an enormous level of spending like never seen before in the US under Biden. It ended up being called the Inflation Reduction Act. There was one senator who, from West Virginia, who was very obstructive to the entire act. So over the summer, they got him on side, and since then, they've passed £400 billion worth of spending to be spent over the next 7 years on green energy, on green hydrogen, on energy efficiency, and that whole space, including energy storage. They're also really focusing on infrastructure. It's only so good having all these electric cars and all these semiconductors made in the US, and there's been a lot of movement around that, all of this renewable energy. But if you can't charge the vehicles and store the energy, then you can only get so far with regards to a shift to the green transition. But this is pretty momentous from the US. From 2014 to today, the biggest spender on green energy has been, or the green transition in general, has been China. Over $1 trillion US has been spent by China since 2014. Second biggest spender globally is the US, with 480. So this doubles all spending from 2014 to today in one act and gets the US closer to the level of spending that China's undertaken. Now, China is going to keep going and keep deploying, and there's been record levels of deployment from China this year. They are clearly seeing themselves and want to be the climate innovators, the climate leaders, and are seeing that as a big point of difference. But the good news is, from the US's perspective and the kind of global emphasis on sustainability and the green transition's perspective, they see the political risk in having China as such a dominant leader. We've seen the move that's happened over the last few weeks with regards to banning US companies selling semiconductors to China. They've also banned the import of semiconductors from China. So the US are really trying to stabilize themselves or position themselves as a competitor to China in many of these areas. But it really is a significant shift with regards to the amount of money that's been spent and committed. Usefully, most of it comes in the form of tax credits. So this is incentivizing businesses in their own right to be investing in all this stuff. So they get credit from the investment, incentivizing businesses themselves to think about how to do this most effectively, rather than just setting up loads of public partnerships or public projects. They get more tax incentives if they employ US individuals working in the US, and they get further more tax incentives if they pay those individuals a fair living wage. So it's a pretty holistic approach to a green transition. It's this idea of a just transition. You can't just fix environmental issues and then have loads of social degradation because all of these mines, coal mines have closed. It's a very, very holistic way of looking at it, and hopefully acts as a real step change with regards to the US being on the global stage for the energy transition. Staying on the US, we are living in a very divided world, and that's certainly something that's been a theme for a few years now, I'd say probably sort of 5 to 7 years, and it's no different in the ESG space. So this chart here shows state by state the states that have implemented or are considering bills or policy statements that direct public money, so mostly money in pension funds, to socially conscious standards. So each state has, as you can see here, lots of the states have made a ruling pro or anti-ESG. Can these pension funds implement ESG policies within their investment policy statement or not? And it's remarkable, the split that you have seen. So very, very actively, many states have said, BlackRock and your sustainable offering, not welcome. Schroders and your sustainable offering, not welcome. So this is really the politicization of this concept of ESG. Now, I think this is probably quite to be expected, particularly in the US, where things are so polarized, particularly as sustainable investing is very much coming to the fore and being thrown in our faces in many spaces. We're actually seeing the same thing happening company by company. So there's a company that we spoke to the other day, which is a company that provides insurance, health insurance. A big part of their business is to provide health insurance to underserved demographics. So people that are on very, very low wages that don't have any access to healthcare insurance otherwise. When you go into the blue states on the West Coast here, they're going out with their impact reports, talking about how beneficial all of this healthcare insurance is for these people that would have no access otherwise. When they go into the red states just next door, they put those reports away in the bag and just talk about the amount of money, the very sort of bare bones of exactly how beneficial they are and how successful they are as businesses. So the fact that companies are having to do that just by stepping over the border and repositioning their business model, I think really brings this to life. I personally think this will kind of all come out in the wash. I think that when this was in the lead up to the election and the midterms, we all know that was nowhere near as successful for Trump as he was expecting it to be. And maybe this politicization really didn't hit home for many investors. I think that probably this, as I said, will come out in the wash, and there will be a much more sort of softer and more nuanced approach. And I don't really expect the anti-ESG rhetoric to stay. There's lots of court cases going on at the moment as to why, particularly here in charity commission land, that charity trustees should be considering the non-financial views of the charity itself. So if it's an environmental charity, they should be thinking about implementing environmental standards with regards to their investment policy. So that's so diametrically opposed to what's happening over here. I think there'll probably be some sort of middle ground created in the future. The good news is regulators are much more on top of all of this than they were before. Now that's happening in our industry, in the financial services industry. We've had Goldman Sachs and BNY, two really big asset managers, under investigation for the use of ESG as a phrase within their funds. Lots of funds just having ESG or sustainable in the title of the fund and very little going on underneath the bonnet. And the good news is they are under investigation. Deutsche Bank's had a real drama. So they had a greenwashing allegation from the head of sustainable investing last year. She then got fired unceremoniously. And then this year, the German police had to go in and raid the offices of Deutsche Bank. They took away hundreds of files, and the CEO left the next day. So Deutsche Bank are not in a good place with regards to ESG. Effectively, they'd been using this phrase ESG integration, so the integration of environmental, social and governance factors in all of their marketing material on all of their strategies, when the head of sustainable investing said this is this thin, that it's skin deep what they're doing. So they're under real investigation. Here in the UK, we've got a recent change in legislation around the requirements of people like me and Nick and Andy with regards to how we use the word sustainability and really backing that up with evidence, which is a very good step forward. And that follows in the footsteps of the European regulation. But we're also seeing wider regulation, and this is an advert that was during COP last year in Glasgow, done by HSBC. And they were they were alleging that all of their businesses were net environmentally positive, conveniently excluding all of the fossil fuel funding that they do on the other side of their business, which on a net basis is massively negative to the environment. So they were going around saying how nature positive they were. The advertising standards have said that that isn't appropriate, that you can't do that, and have made a specific ruling against HSBC. So I think these are sort of good baby steps forward, that businesses can't just come out and allege that they're good or allege that they're sustainable. There really needs to be a lot of net analysis done and substance behind the statements. So I think we'll see that across the fashion industry, where there's a lot of greenwashing going on, and certainly in the financial services industry, there's already a lot of work being done. Almost finish on Drax. So some of you may have seen the Panorama program since I last saw you on this business Drax. So Drax is a biomass business. It provides alternative energy sources by burning wood chip effectively and producing energy. Now this is seen as a positive alternative to fossil fuels, which I guess from some angles it could be seen as that. Drax, however, source their wood from Canada. So you're putting a load of wood on a very carbon-intensive cargo ship from Canada to the UK, burning the biomass in the UK, and then saying it's positive from a carbon perspective versus the fossil fuels that are also burnt in the UK, completely ignoring the embodied carbon that takes that wood from one place to the other. So whilst this is heralded, or was heralded, as a bit of a sustainable option, and lots of clients were investing in this company, we were pretty uncomfortable with the fact that the wood had to come so far. The Panorama program actually took things one step further, and information that we didn't know at this time, the trees that were being cut down were protected trees, and there was a mass biodiversity loss as a result of the work that Drax have been doing in taking these trees down. So I think Andy wanted me to talk to you about this a little bit, because we're not just investing in the kind of shiny green stuff and taking everyone's word for it. We're really thinking about what's the whole life cycle of that biomass. What's really taken in consideration, or what did this business really do when it's taking those trees from one place to the other? We certainly weren't to know that they were secretly chopping down endangered species, but I think it's very, very important to have that deep dive analysis and have that company by company analysis that we do. I wanted to leave you with something interesting to think about. So this could be potentially a glimpse of what the future could hold. So this, some of you may already know, is a city based between Egypt and Saudi Arabia. It's actually right on the cusp of Egypt and Saudi Arabia. It sits on the Saudi Arabia side, but it's outside of Saudi Arabia from a legislative perspective, and they're building a bridge from it all the way to Egypt. It's a city called Neom, and it exists in a 70-kilometer line. And the concept of this city is zero waste and really no impact on the environment at all. So no food waste, no waste as in physical waste, no energy waste. It's doing this by building the buildings which you would live in on this level. Then this level is where you have the shops and the offices. And then this level is where you have the transport. So the transport for the goods that you're buying, and also to transport you around up and down this very long line, which is the city itself. So they've already started to build this city. The good side of it, is the fact that as a result of this enormous multi-million, billion, trillion pound project, they are funding some really nascent industries. Some of those vertical farming companies that I mentioned to you are seeing massive contracts being given to them by this city, NEOM. And so companies that would otherwise maybe never get to economic viability are suddenly overnight getting £1 million contracts and being able to produce what they produce. And hopefully we've got some solutions that otherwise wouldn't get funded. The negative side of it, as you would potentially guess, would be around human rights. And there's a lot of allegations of individuals who have been living on this land for hundreds of years and families for hundreds of years just being cleared off or even potentially killed to make space for this sustainable city and sustainable living space. So definitely watch this space on NEOM. There's a lot of stuff online. It's quite interesting to see the kind of technological advancements that are being invested in by the Saudi regime. They're desperate to be diversifying their hydrocarbons business, and you're seeing the same in Dubai. That whole area of the world particularly had a spotlight shone on it this week or last week as a result of COP. COP next year, COP28, is being held in Dubai. So again, there's going to be a lot of focus on the UAE and Middle East region potentially being one of the parts of the world that might produce some of the major solutions that we need. So whilst they haven't really been in the conversation until quite recently, they've obviously got enormous amounts of money. They've obviously got a lot of risk in the fact that they only make hydrocarbons. So they may well put their hat in the ring with regards to becoming the climate innovators and leaders of the future like China are today. And that's everything from me.
Thank you, Phoebe. Thanks. It's the usual disclaimer that says don't do anything rash on your own. If you want to talk about this further, please speak to your advisor before you do anything. I'm going to just close that down so I don't get completely blinded, if I may. While we do questions, and can I remind anybody that's online, please, that you can send in questions through Slido, so please do. If you have a question, if you could just put your hand up like at school, and Andrew will bring a microphone around so everybody on the stream can hear you as well, please. Yes? Can you wait for the microphone, please, too? Can you wait for the mic, please? Thank you.
How do you spell the name of that city that you were talking about? Because I've never heard of it before.
NEOM.
NEOM.
NEOM, yeah.
Thank you.
Yeah.
I shall Google it.
Yeah, do.
It's just fascinating sci-fi kind of look of multi-layer, and I don't know how people feel about living and working underground with no natural light and so on. But I'm sure they've thought very long and hard about how to make that a bit more bearable. Jennifer, do you have some online ones?
I do indeed. So the first one perhaps follows on quite nicely. I know Phoebe just talked about carbon intensity and how we look at it from a risk perspective. But this client has asked here, what can I do to measure or offset the carbon impact of my investments?
So I can provide the stats around the carbon that's connected to the investment. I mean, that's basically that chart there scaled up to the portfolio. In terms of offsetting, it's slightly more difficult, not impossible, but there is quite a large unregulated industry around carbon offsetting. So I imagine the work that you've done in terms of finding the business that you want to use as an offsetting organisation took a long time. There's a gold standard that you can see that can be applied to those businesses. What I mean by that is about this kind of unregulated space is there's a lot of allegations whereby a company says they own a load of trees and then they can work out the carbon extracted, sequestered by those trees or by the wetlands or by the ocean, whatever it is. And then that comes a carbon credit, but that carbon credit is sold over and over and over again. So you really don't want to just be using any offset company. You want to make sure that you can find a company with that gold standard regulation. And then you can offset by the level of the carbon in the portfolio. It's something that we'd love to be able to offer as a business. We have arrangements with lots of carbon offset organisations. Our company itself has entered into an agreement with the largest carbon capture and storage business. So that's actually physically extracting carbon in a huge extractor fan in Iceland and then burying it underground. The cost per ton of carbon ranges between $600 and $800 US dollars, so it's really, really expensive in comparison to when you're getting carbon offsetting from trees, which is much, much cheaper. But so when that cost comes down, and we'd love to offer that as an ancillary service to our clients, but at the moment it's just so prohibitive for most people to want to pay that amount of money. But certainly it's something that people are interested in finding out about. If you haven't done the calculation of your carbon footprint as an individual, it's quite interesting to see there's quite a lot of good carbon calculators out there just to understand what you're eating or how you're traveling, what clothes you're buying, your daily life, just to get an indication. It's sometimes a bit more shocking than you'd think.
Could I just ask, whoever sent that question in, because the obvious interest to us as a business is their interest in us having a sustainable proposition where built into the costs of that, it does offset all the carbon footprint of the companies in which we're invested. And it is incredibly complicated, this stuff, to work out all the supply chains and so on. So I'm not saying we'd have it tomorrow, because we absolutely will not. It is a complex piece of work. But I'd be interested to know, and ask the room as well, actually. And if this person could send perhaps another, not so much a question as an answer in, please. Would you be interested in a proposition where the offsetting of the emissions was built into the proposition?
You can tell us afterwards. We don't want to guilt trip you into saying now.
Phoebe just saved you from a show of hands, so well done, thank you. Yeah, but please do. Yeah. If anybody would be interested in something like that, which would, I guess, be another layer on top of Gaia, where effectively we would invest your money as we do now, perhaps, but then there would be some charge built in, where you would then go and offset the emissions of the companies in which you're invested. If that is of interest, please do tell us afterwards, because it is it's not somewhere we've gone yet, but it is something has come up in discussions. Yeah. So perhaps if that person would like to, please send us in your thoughts, we'd be really grateful. You got some more, Jennifer?
I do. I have another one here. So, is this a good time for younger members of my family to consider investing their savings, or should they wait for a more stable market?
Can I take that one? Because I've got a really good example of this. Of someone I spoke to. It's another financial advisor who takes investment advice from us. She's a one-person band, and she had a client who invested some money about a year ago and probably caught the top of the market in the short term. And this person said to her, the thing is, I inherited this money in 2016. But it was Brexit then, and it was all messy, and it was all very volatile, so I didn't do anything with it, because I wanted to get through that uncertain period. And then that calmed down. I was just about to invest it, and then the pandemic came along, so I waited then, and then I because then it was uncertain again, and then of course once that had passed, then I felt that it was now a more stable environment in which to invest, which was about a year ago, which of course turns out to be not a great starting point to invest in. And of course, had this person invested in 2016, I put the 5-year performance slide up not so many minutes ago, they'd have had a very good investment period, because throughout all that nonsense of Brexit and all the shenanigans there and COVID and so on, markets did well. And then of course you get into this supposedly calmer period and markets struggle. You just don't know what markets will react to. They don't react to the same things that perhaps you and I react to on a day-to-day basis. So the answer very simply is, who knows? Candidly, it's always time in the market that fixes the problem, not market timing. Having said that, Nick put up a slide earlier on that shows that equity prices are at much, much better levels. The US market is certainly not expensive like it was. Other markets like the UK and emerging markets, China, look optically cheap, and fixed interest is much more compelling now. So, with the big caveat of you never know, I would say it looks much more attractive now to start than it did 12 months ago. Is that a fair comment? Yeah?
Yeah, I think, markets are at a stage where, do we have a soft landing or do we have a recession? If you have a recession, you may get another leg down in equity markets. If you have a soft landing, they may just go up, and that's a very difficult thing to judge.
Hopefully that gives them the answer they want. Any more, Jennifer? No? Yes, please. Can you just wait for the microphone, please? Thank you.
This is a false liar in a sense. I'm going to use a new word on you that is actually disappearing from the vocabulary, so I'm wondering if you're going to be able to cope with it.
What is the blatherskipe of Brexit at the present moment?
Blatherskipe.
Blatherskipe. It's one of the words that is actually withdrawing from the vocabulary that we have at the present moment. There are about 25, you were saying. Blatherskipe means gossip from Durham.
Okay, because I've already withdrawn it from my vocabulary. Because you had me completely, sorry.
All I'm really going to say in that is, has Brexit really been of great benefit to us? I know that the government seem to say it's the sort of the way forward, but I don't really believe it myself, and I can't see many examples, to my own mind, of how that's actually benefited our country.
Am I taking that one? Yeah, okay. Yeah, crushing silence. There we go. Not me. I think, funny enough, I was talking about this to somebody before we started today. Any analysis of Brexit in the short term, economic or any other way, was made very difficult by the pandemic. And if you were an advocate of Brexit, politically, you're a politician, Boris Johnson et al., that was in favour, of course, you can say, well, of course things are tough. That was the pandemic. And it's impossible to argue or to prove anything else. I don't think anyone can really pull numbers out about what's caused what. I think those, shall we say, more honest Brexit politicians said there will be an economic headwind in Brexit in the short to medium term. I don't think anybody thought that was not going to be the case. And there were people, much as other people were just trumpeting the 365 million a week that we're going to save, which wasn't really true and all that kind of stuff, there were other Brexit politicians who were saying it will be difficult in the short term. We will have adjustments to make and so on, but we believe 10, 15, 20 years out, you'll start to reap the benefits. So I don't think anybody would say anything different has happened. We've had a pandemic on top, which has been really, really bad timing, so that even if you say, I still think it'll be good long term, it's horrible timing that we got the pandemic right after this, but I don't think anybody can argue there's been a benefit economically, certainly of Brexit yet. Whether there'll ever be, that was always the great unknown, wasn't it? It was always a leap of faith, but I don't think even the most ardent Brexiteer would say that things have got better in the short term, because they were never likely to, and it was always part of the deal you had to accept. If you wanted the longer term gain, if there was such a thing, you probably had to accept short term there'd be problems. I don't know if anyone would like to disagree and think that things have improved as a result of Brexit, but I mean, it's hard to know what's caused what, is my instinct as well. No, it's fine. It's fine. You got to, it's difficult not to wander into politics and make it about political views. I was very clear, I think, with all of you. I always thought that whilst I was no fan of the European Union, the Commission and the structure and lack of democratic accountability and so on, I thought it was a bad idea economically to leave. So my head said leave, my heart said leave, my head said stay. That was always my position.
And I guess the only thing to add there is for some Brexit politicians, of course, it wasn't about economics. It was about other reasons, and they weren't worried about the economics impact. So I guess that's the other thing.
Any more words to catch me out with? Blatherskipe wins the award so far. I get blather. Blather I get. I'm now wondering if Skype came from that or something. The pre-Zoom version. Any more for any more? No? Are you just hungry now? Would you like to be fed and watered? Are we ready? I hear banging and crashing. Yeah, I thought with that banging that probably meant we were, yeah. Well, thank you for your attention. Thank you to all of you that have come online. We really do appreciate it. And we'll see you next time round. For those that are here, please come join us for a glass of something and some food. Thank you very much.